I hope you're ready for today's module because this is where your advanced education begins. Today is day 9, Harmonic Patterns, and today we're advancing your technical knowledge with an introduction to harmonic patterns. Now in today's game plan, it will be a 4-topic module going over the method and the madness, followed by finding M's and W's, then Fibonacci retracements, extensions and projections, and finishing off with bullish and bearish bat. Now in yesterday's module, well, it was a 2-part module. We had day 8 technical analysis and part 2 as well. Now in part 2, you learned how to analyze price structure in various ways. So beforehand, we learned about trend lines, channels, support and resistance. And then you went on to learn triangles, which are bilateral patterns, pennants, which are continuation, wedges, again bilateral, and then flags, which are continuation. You also learned about price gaps, which will play a key part later in the Harmonic Mastery course. Now remember, the key to everything you have learned throughout the 14-day course, and this applies to everything that is still yet to come, the main thing is application. There is no point doing the courses and then not applying what you learn. Of course, as I mentioned in day 1, the 3 core fundamentals to successful trading is mindset, knowledge, and experience. So remember, you need to apply everything you learn. Of course, you learn through experience. So if you're learning about support and resistance, channels, trend lines, pennants, start looking for them on the charts. Get used to finding these formations in the market. Now onto our module for today. Topic 1, the method and the madness. Now, for many of you, you may be thinking, what are harmonic patterns? Of course, harmonic patterns, this is the base of our trading strategy. Of course, in day 7, day 8, we were just building the anticipation. We were learning how to analyze the market, whereas harmonic patterns is the base of our strategy. So we're actually getting into the nitty gritty stuff. So harmonic patterns, these are typically 5-point price structures in M or W formations. So they literally look like an M or a W on the charts. And the entire method is based upon the premise that specific price patterns repeat themselves, which they do. Of course they do, otherwise I wouldn't be teaching this module. So like we went over in day 8, we went over the examples of pennants, we went over channels, trend lines. Of course, these specific chart patterns, the way that you can analyze price, they repeat themselves, and so do harmonic patterns. It is a measurement based approach. It's very, very specific, and I'll get onto that later in today's module. And harmonic patterns analyze natural price points within cycles of growth and decline. So what they essentially do is they analyze the cyclical traits of trading behavior. So again, kind of looking at the sentiment part of the charts as well as technical. So harmonic patterns, there is a lot of thought behind how the methodology works. And again, this will be covered in greater detail in the Harmonic Mastery course. Today is simply an introduction to harmonic patterns. Now, it combines 2 schools of technical thought. The first being wave theory and market structure. So wave theory by R.N. Elliott. Now it's Robert Prechter and A.J. Frost. They're doing a lot of what is known as Elliott wave. They're doing a lot of the research behind Elliott wave, but it was created by R.N. Elliott, and market structure by Charles Dow. So a lot of the research on that side has been present for the last 100 years. It's been very popular throughout the 1900s. Charles Dow, he created the Wall Street Journal. I'm sure a lot of you know what that is today. And that side of harmonic trading is combined with sacred geometry ratios, which was W.D. Gann. So all legendary traders, legendary investors, they're very well known in the industry. So these 2 schools of technical thought are combined, and this is what creates harmonic patterns, harmonic trading. Now, Scott Carney, he created many of the harmonic patterns that are in existence today, such as the bat pattern, the crab pattern, the deep crab. We also have Arthur Merrill, who created Merrill waves, to thank. A lot of the patterns that are in existence today were based upon the structures and his findings a very long time ago. And J.M. Hurst, who created Hurst cycles, again, a lot of the work from Harmonic Patterns was based upon Hurst cycles. H.M. Gartley, another legendary investor who was mainly based in the stock market, he created what is known as the Gartley pattern, but back then it wasn't a measured move, but the pattern that exists today based upon his work. Larry Pesavento, again, he contributed towards a lot of what is now known as harmonic patterns. So again, harmonic patterns is a very successful methodology. It combines a lot of very in-depth schools of technical thought. It is based upon findings that have been proved over time. Now, harmonic patterns today, well, they've changed a lot since they first began. So why harmonic patterns? You may be asking why. Why should I even consider harmonic patterns as my method for trading? Well, harmonic patterns, and this is the main point here, they form in all markets on all time frames. So if you're a day trader, a swing trader, or even a scalper or position trader, you can use harmonic patterns in your approach. And more importantly, actually, if I want to trade stocks, for instance, or cryptocurrencies, I don't want to have to change my strategy completely when trading a different market. Whereas I can use the exact same approach for all. I can use harmonic patterns to find specific buy and sell levels, whether it be stocks, cryptocurrencies, or Forex. And that is truly what's important to me. Now, harmonic patterns, they are precisely measured structures. So again, we'll go over this today. And they utilize specific price levels to mark optimal opportunities. So optimal opportunities in which you can buy or sell to make a profit. Now, they are pattern specific strategies. So again, specific measurements, specific structures. Just remember that. And they simply optimize the decision making process. And that is what many traders struggle with. They struggle to pull the trigger. They don't know when to buy or sell. Let's say a setup forms completely and everything ticks all the boxes, but they simply don't know when to execute. They don't know when to buy, they don't know when to sell, they don't know when to get out of the trade, they don't know how to manage a trade. And harmonic patterns provides the framework to allow traders to understand what to do in every instance of a trade. So not only does it help you identify a profitable or potentially profitable opportunity ahead of time, so this may be 2 weeks ahead of time, you've identified a harmonic trading setup. You know that the setup will complete within the next 1 to 2 weeks, which is perfect. And once the pattern does complete, you then know whether to buy or sell. And once you're in the trade, you know exactly how to manage your position and you know exactly where you're getting out before you get in. And that is probably what's just as important as being able to trade it in all time frames in all markets. And what I'm saying here is it simplifies the process of execution. It helps you pull the trigger. It takes away all of those anxious thoughts of should I be in the trade or should I be out. It allows you to determine if it hits this price level, I'm going to buy or am I going to sell? And that's exactly what we'll cover in our second topic, which is finding M's and W's. Now in this topic, we're just going to go over the structure of the patterns. So again, like I said, they are 5-point patterns. So what we're going to do is we're going to cover the structure of the patterns and then we're going to add in the maths. So the measurement based approach, so the measured moves. So harmonic patterns will appear like this. This one is a bat pattern, but again, we will cover this in topic 4 today. But for now, let's just keep it simple. M's are simply bullish patterns. So when you find an M type structure in the market, you're looking to buy. Now, once it completes a certain price level, this is called the potential reversal zone, known as the PRZ. And this is where we're looking to, of course, we're looking to execute the trade and we're looking to buy. Of course, these are reversal type patterns. So of course, we've got the very long move down to the PRZ, and this is where we're expecting a price reversal. And we're looking to buy, of course, price now heading in the opposite direction. Now W's, these are bearish patterns. Of course, once a W pattern completes, because they are reversal type patterns, we are looking to sell. Now here we have the potential reversal zone, again the PRZ at the top of the W. So again, a reversal type pattern, you're looking to trade in the opposite direction of where price is going currently. So what I'm going to do is I'm going to go over to TradingView. We'll go over both types, bullish and bearish patterns, but again, I'm keeping it simple. We won't add in any measurements for now. All we're focusing on is the structure of these harmonic patterns. So let's over to TradingView. First of all, we'll go over M-type structures. Here we are on TradingView with Great Britain Pound, Japanese Yen on the 4-hour chart. And what we're looking at is an M-type structure in the market. That is really just the first thing you want to do when you're identifying the move. You want to identify a clear and distinct M or W type structure in the market. In this opportunity, we're looking at an M-type structure. And when we're measuring the move, I'm going to highlight this with the trendline tool. We strictly measure from the lowest to the highest point. We're not measuring from the closing price or the open price. We're measuring from low to high, high to low. And I'll highlight this just now. We're going from wick to wick. We can see the highest point in this area is in fact this price point here. We're not measuring this point or this point here. We're going with the highest point in that area. And like I mentioned, we're not going with the closing price. We're looking at the wick of the candle. We're looking at the highest and lowest price. We want to be exact in our trading, exact in our measurements, and identifying potential trading opportunities. We don't want to leave any room for error. So if we can be very thorough in our measurements and identifying trading opportunities, it can save just very small mistakes that can happen along the way in developing bad habits. Like I said, we're not going with the closing price or the open price of the candle. We're going with the lowest price in that area. You really want to go from the lowest point to the highest point to the lowest point when you're identifying these M and W type structures. Same again, we're going with the highest point in that area. And this is our final price leg, which would define the potential reversal zone, the completion of the pattern. Now at the moment, we're only looking at the basic structure. We're not adding in any measurements at all. That is what really defines the completion of the pattern once we confirm all of the ratios, all of the measurements in the move. And the potential reversal zone, which I highlighted on the slides with a circle, it's really an oversimplification. The potential reversal zone, it isn't really a circle, so to speak. It's really an area where multiple measurements converge within a close proximity. We're looking to have as many measurements form within this area as possible. And the more measurements we have that converge within a close proximity, it provides an overall better structure, but it provides, of course, a greater trading opportunity. It has more potential for a reversal to occur, especially when we have multiple measurements that can converge within a very close area, close proximity. So that's what we really want to remember. The potential reversal zone isn't just one singular measurement. It isn't just one circle. This is really just an easy way to highlight what we're looking at when the move completes. The potential reversal zone will really look like something like this, where we have multiple measurements that form within a close area. And the last measurement that is confirmed, the candlestick that confirms that last measurement in that zone, that is what's known as the T-bar or the terminal price bar. And that's really an important discovery in the harmonic trading approach defined by Scott M. Carney, an extremely smart man. And we just want to pay attention to that. We want to pay attention to these measurements that form within a close proximity. That is what confirms the reversal. And once we get a test of that final measurement in the potential reversal zone, we're then looking to execute the trade. In this situation, we're looking to buy upon confirmation of the final measurement in the potential reversal zone. So once that candlestick closes and confirms the potential reversal zone, we really want the candlestick to close above the final measurement. We don't want price to far exceed of course, we don't want price to close away down here. Then we would have extreme price action going into the potential reversal zone. We want to see these reversal type candlesticks. We want to see a confirmation of the measurements in this area. And I will explain this in greater detail throughout this module. Don't worry if you're feeling maybe overwhelmed or confused at the moment. It will make perfect sense. And when we get a confirmation of the potential reversal zone, we're then looking to execute the trade. And because these are reversal type formations, we're looking to trade in the opposite direction. In this situation, we're looking to buy. We can see we had an instant reversal away from the potential reversal zone, and it went straight into profit. We then had a pullback, and then price completed the full extent of the move, and it would have hit our take profit level around about this area here. Now, stop loss and take profit levels, this will be defined in day 12 risk management. We will talk about how to get out of a trade, not just in profit, but in a loss as well. Of course, nobody can be 100% correct in trading. That's probably the most obvious thing I've said today. Everybody will lose. It's a part of the business. It's a part of trading. Everybody loses. It's just a natural thing. Nobody can be right 100% of the time. So we need to have defined rules for getting out of the trade, whether that be in profit or in a loss. So we can limit the amount we lose. And of course, we can then establish how much we stand to gain just within one trading opportunity. If we head on to our next chart, we're on Canadian dollar Swiss franc on the 1 hour chart. We're looking at a similar example. We're just looking at a W type structure in the market, which means when this completes, we're looking to sell. Remember, an M type structure is a bullish formation, which means we're looking to buy upon completion. A W type formation is bearish, which means we're looking to sell. We're going from the highest price to the lowest. Like I said before, we're not going from the closing price or the open price of the candle. We're going from the lowest to highest. And this is typically wick to wick. You may find that the closing price is the last price in this area. So that's fine. You're just going from the highest price to the lowest price in those measured areas. Same again here. We're going with the midpoint in our W structure. We're going with the highest price point in this area. And as you can see, some of these formations, they are harder to identify than others. And this all comes with experience. I don't expect you to identify 100 M and W type structures today when you go onto the charts. It will be quite difficult, and it will be challenging at first to identify these formations in the market. And it does take a lot of practice. So that's what I would recommend today. Once you go away, just start with that. Start with the basics. Start with identifying M and W type structures. And this can be on any time frame. Remember, this is just for practice to get you into the routine of spotting the structure. That is, of course, the hardest part at first. And then we can apply the measurements. We're looking at our final price leg that, of course, forms the W. Now, this formation did actually complete. I'm more than confident in this candlestick here. But just to keep it simple, we will use the highest point just to highlight the W structure that we're looking at in the market. The measurements is what really defines the completion of the pattern, as well as the potential reversal zone. That highlights the area where multiple measurements converge. And then we're looking for the terminal price bar, the T bar. And that's what confirms the last measurement in the potential reversal zone. And like I said before, this will make perfect sense throughout today's module. I will explain that in greater detail. And one other point I want to mention is that no matter if you're looking at an M type structure or a W type structure, every single trading opportunity will be different. You will not have a trading opportunity that's exactly the same as the next one. We need to treat every opportunity, no matter what market or time frame you're trading, as an individual trading opportunity. Price action will be different. The overall formation will be different. The candlesticks that form these price legs, we can see here how aggressive that candlestick is there. We didn't have that in the last example. So this means that every single formation you're identifying in the market really has a different message. And this is portrayed through price. what the candlesticks are trying to tell you, the overall structure of the market as well. And we can use that to our advantage. And as we progress throughout the 14-day course and then onto the Harmonic Mastery course, that's when you'll really become comfortable in your trading. You'll understand the natural ebb and flow of the market. You'll be more in sync with the market. You'll understand how price moves. And then that's when you can identify these really highly profitable trading opportunities. And that's one thing I want to mention as well. When we're talking about the potential reversal zone, terminal price bar, and many other measurements that may seem confusing just now, stick with it. As we progress throughout the 14-day course and in the Harmonic Mastery course, everything will become clearer and clearer as you progress. The Harmonic Mastery course really takes everything we're learning today and in day 10 and amplifies it. You're advancing it to a totally new level, way beyond most traders in the market. And it will give you a really in-depth understanding of how these patterns really work. And you can apply that in your own trading. But that's enough for now. We've identified the M&W type structure. That's just really the basics of it. And just before we head on to our next topic, when this move completes, you're looking to sell. And that's roughly where the move would have completed based on our take profit targets. Like I said, we'll cover this in day 12. We can see that the move actually extended down to the lowest point in the pattern, which would actually be the A point. That's what we know as the A point in a harmonic pattern, a 5-point pattern. This is roughly where the take profit level would have been in this area here. So another successful move, and we can see how clear and precise these structures can be. And once we add the measurements, it will make perfect sense. So let's head on to our next topic, which is Fibonacci retracements, extensions, and projections. Moving on to our third topic for today. This is the mathematical side of today's module. As mentioned, harmonic patterns, they are measured moves. So what we're simply doing is we're going over the structure, the M's and W's, that is the overall shape of the pattern. There are many other different formations, but just to keep it simple, that is the shape we are focusing on today. So M's and W's. And then we add the mathematics. So they are measured moves, and we measure them using something called Fibonacci. So Fibonacci is used to measure price segments of trading history, and in our case, to define complex structures. Now, these complex structures, in our case, is harmonic patterns. Now, there is 3 ways we can measure and predict price moves using this method. Retracements, so Fibonacci retracements, Fibonacci extensions, and Fibonacci projections. The following measurement technique is the beginning of our price prediction capability. So Fibonacci levels, if you didn't already know, and for most of you, you won't, Fibonacci levels are amongst the invisible levels of support and resistance in the market. The levels in which price bounces or breaks. So again, Fibonacci is used to identify key support and resistance levels in the market, levels in which price will reverse, or levels in which price will break through. Now, a retracement in the market is less than 100% of the full price move you are measuring. So let's imagine you're measuring from low to high, and you have a retracement in the market. Let's say the market is trying to make a higher low. Now, you can measure this move, and if it's less than 100%, let's say it does not return back to the previous low, let's say it creates a higher low in the market, this would be what's known as a retracement. Now, an extension or a projection is above 100% of the price move. And again, we'll go into this in our next slides. We'll go over a retracement, projection, and extension. So again, the ratio for a retracement is less than 1.0 or less than 100% of the price move. For an extension projection, the ratio is above 1.0, again, greater than 100% of the price move. But I'll make this as simple as possible for you on the next slides. And these measurements are among, as mentioned, the invisible levels of support and resistance. So just keep that in mind. I would note down pretty much everything that is on this slide. Now, this is a retracement situation. We have what's known as the primary leg. So this is the price leg that you're measuring. So you've got X to A. Again, I'm just using these very basic letters to keep it simple for you guys. So we've got X and A. You're measuring from X being the low to A being the high. Okay, so this is your price move you're measuring. And we have B, which is the retracement leg. And in this situation, this would be a 100% retracement. So you can see here, B returns back to the same price level as X. So let's say that B didn't return back to X and it only was half the size. Then this would be a 50% retracement because it's 50% of the length of X to A. I hope this is making perfect sense. If not, don't worry. I will go over a live market example for you. Now here we have what's known as a projection. So we have X to A. This is the leg you're measuring, the price move you're measuring. Again, the primary leg, this is what you're measuring. Now we have what's known as the projection leg. You're measuring X to A, and this provides you with B, the projection leg. Now you notice that B is beyond 100% of X. So you can see here that you are measuring X to A, but price past X, therefore it is beyond 100% of the area you're measuring. So in this situation, it may be twice the length, so it'd be 200%. It may be 1.618, which don't worry, I will explain what that means in today's module. So again, it might be 1.618 times the size of X to A. Now our next example is what's known as an extension. So again, you're measuring, in this situation, you're actually measuring 3 points. So you've got your primary leg, which is X to A. Then you have what's known as a retracement leg, which would be B. So in this situation, you've got your retracement, which is, of course, below 100%. So we're utilizing that as well. And this is what provides you with an extension. So you can use, in this situation, you're measuring from X to A to B. And then you're getting your extension, which is beyond 100% of A. Again, so this could be 200%. This could be 361%. It could be whatever it is. As long as it's beyond 100%, then this would be an extension. Now, just to mention, and this is where the confusion comes in, and I'll try and keep this as simple as possible. Many people refer to a projection as an extension and an extension as a trend-based extension. So just keep that in mind and don't get confused. You need to understand, if you do come across someone else and they're talking about extensions, they may actually be talking about projections. A lot of people get this wrong, and it is quite common. So again, I wouldn't say there's a right or wrong way to do it. This is just how we do it. We have retracements, projections, and extensions. Very, very simple. So just keep that in mind. Some people refer to projections as extensions and an extension as a trend-based extension. Okay, there's no right or wrong way to do it, but just keep that in mind. Now, when you're measuring these retracements, these projections or extensions, we use something called Fibonacci ratios. And to break it down even further, they can be changed into percentages, so it measures the extent of the move. And don't worry, I will put this into a live market example to break it down for you even further. But for now, write these down. This is the exact ratios we use to measure our harmonic pattern structures. Again, you can apply these measurements in the market as well to find key reversal levels. This may be in a trending situation or even a ranging market. So we have 0.236, 0.382, 0.50. So again, these measurements can be converted to percentages. So again, like I mentioned in the retracements, if you're measuring X to A to get a retracement, which is less than 100%, this could be 50%. So 0.50 is 50%. We then have 0.618, 0.707, 0.786, 0.886. Then you would have 1.0. That would be 100%. 1.13, 1.272, 1.414, 1.618, 2.0, 2.24, 2.618, 3.14, and 3.618. So a whole lot of numbers in there. There's a lot of numbers. Don't get confused. So what I want you to do is write all of these down. These are extremely relevant to our trading strategy. Without them, it would be nothing. Again, our strategy combines two schools of technical thought. It combines wave theory, market structure, with sacred geometry ratios. So again, that's the mathematics. So this is the mathematics that make the patterns measured moves. And again, this will make perfect sense as we progress through today's module. Now, as mentioned, these Fibonacci ratios can also be displayed as percentages. Now, this may make more sense to you. So if you're measuring X to A of a price move, so low to high, to get a retracement level, you may find that it is 50% of the length of X to A. So the low to high, you may find that the retracement, the next higher low in the market, is 50% of the move you're measuring. You may find that it's 61.8%, 70.7%, and so on. When you're measuring an extension or projection, you may find that when you're measuring from low to high or high to low, you may find that it's double the length of that price move you're measuring. So that would be 200%. So what I want you to do is write down the ratios, write down the percentages as well. You could screenshot them, keep these handy. And what we will have later in the 14-day course is an ebook with everything that you need in it. So you can keep it open while you're trading. But for now, you can write these down. We're just in the learning stages, of course. We want to learn how to apply Fibonacci in the market. There is a lot more of thought behind why these numbers work. They are universal. And right now, I feel an introduction to that kind of side isn't relevant. I don't think I want to overwhelm you guys with that kind of information. So you will find this in the Harmonic Mastery course. But for now, all we're focusing on is learning how to trade harmonic patterns. So let's go back to TradingView. I'm going to give you an example of a Fibonacci retracement, a projection, and also an extension. We're back on the charts. We're looking at Great Britain Pound, Japanese Yen on the 4-hour chart, and we're just going to apply all of the measurements you've learned individually. We're going to be looking at retracements, projections, and of course extensions as well. And the tool you want to use, your main tool, will be the Fib retracement tool. This can be found 3 down, where we find the pitchfork. It's around about the middle section. It's called the Fib retracement tool. And if you remember the M-type structure we drew up in the previous topic, this is the exact same chart. We're looking at pound yen, the exact same trading chart. We're going from the lowest price to the highest price. We want to add in our ratios, and I'll just add in the trend line so you guys can see exactly what I'm measuring. We can see the dotted line there. We're going from the lowest to the highest price. And we'll add in a 382 measurement and a 0.5. You can also extend the lines if you want. You don't need to. I'll remove the background as well. And you can also display these as percentages. As I mentioned before, these ratios, they can be used as percentages. I use them in their standard form as a typical ratio. I don't use them as percentages, but a 0.382 would be a 38.2% retracement. A 0.5 would be a 50%. I feel it's quite self-explanatory. We've got a 0.886 would be an 88.6% retracement. So it's up to you. If you feel comfortable using percentages, there's nothing wrong with that. I feel it's good to use the ratios and understand them. I use ratios. I feel you guys should as well. We can see here this price leg. If I just use the trend line tool, we're measuring this leg here. This is the primary leg. This is the retracement leg here. We can see that price confirmed the 382 retracement. This would then be defined as a 382 retracement in the market. If price was closer to the 50%, we would then need to consider that a 50% ratio in the market. The market is never perfect. We really want to look at these levels within a close proximity, like we do with the potential reversal zone. Like I said, multiple ratios forming within a close proximity, they converge in a close area. When we're looking at measuring price levels, once we get a confirmation of this level here, we really just want to look at price within a close proximity. We want it to reverse within a close area. Once it confirms this measured level, which would be the 382 retracement, and then we're looking for a reversal in the opposite direction. So this would be a basic retracement. And while we're looking at the retracements, I just want to identify all of the retracement ratios that can be used in the market. We've got a 0.236, a 382, a 0.5, a 618, a 707, a 786, 886, and a full retracement would be 100%. And this would bring us back to, of course, 100% of this price move, which means price would return to this area here. We can see that price would be measured at 100%. Anything beyond that, we would then consider a projection. And this is when we look at the ratios of 1.13, 1.272, and so on. And while you're on TradingView today, if you can actually make this one of your jobs today, maybe a piece of homework, while you're noting down all of your ratios, when you go into TradingView to practice for yourself, organize your ratios. Once you go on, you'll see that the ratios stated. A lot of the ones that you use might not be there, or they might be muddled up. It's good to have them in order so you can very quickly select the retracement ratios you want to use. Sometimes TradingView can mix with your settings, so sometimes you will go onto the charts and it won't be saved, but most of the time the ratios will be in order for you. So if you just do it once, it should stay the same and you won't need to do it again. And we can see we've got 1.13, 1.272, 1.414, and so on. So it's very easy to find what ratio you want to use rather than having them all mixed up and you don't know where your 1.618 is. It just saves chart time. And that's one thing I think you should do today while you go into the charts. The next measurement we're going to look at, if I just remove everything off the charts, is a projection. And this will all make perfect sense once we're looking at measuring the M&W type structures and we apply the measurement rules to the harmonic patterns. Remember, a projection is beyond 100%. We're looking at a 1.13 and so on. And I'm more than confident this completes at a 2.618. And we can see there exactly on the 2.618, we can see that price dipped just below it. Like I said, everything within a close proximity. And I will define this in greater detail in the Harmonic Mastery course. There's a lot for you guys to learn. Like I said, Harmonic Trading, it's an advanced methodology. It takes quite a while to get to grips with it and fully understand what you're applying on the charts. But we're just taking it in baby steps. We don't want to overwhelm you and introduce too much in the one module. We're just looking at the basic measurements. We're looking at a projection. We can see this would be the 100% retracement from this high here down to the low where we started the measurement. That would be 100%. Anything beyond that, we're then looking at a projection. And as I mentioned before, many traders, they refer to projections as extensions. There may be some confusion there, but just as long as you know what you're talking about, that's all that matters. As long as you know what you're talking about and you know what you're applying on the charts, that's all that really matters. So we know that beyond 100%, we're looking at a projection. And in this situation, we're looking at a 2.618. It could have been a 2.24. Price pushed just beyond that, and it confirmed a 2.618 ratio. The final measurement I want to define is the extension measurement. And this uses 3 points, as we mentioned before. You're going from high to low to high, or it could be low to high to low. And I'll add in the trend line so you can see exactly what we're measuring here. We're using 3 points. And of course, the third point we're measuring is always going to be a retracement. We're not measuring a way up here. We're measuring a pullback of this move, and that gives us our extension measurement. And this is used primarily in what we know as the alternate ABCD structure. This is going to be defined in the Harmonic Mastery course. It's an extremely important measurement that we use in many harmonic formations. And that's just before we go forward. What really makes a pattern harmonic is these ratio alignments within the potential reversal zone, but also sine wave structural assessments. We're looking at ABCD formations within the financial markets. We're looking at either a regular ABCD or an alternate ABCD. And that is really the two types of measurements you're looking for. You're looking for multiple ratio measurements or harmonic or Fibonacci measurements converging within a close area. And you're also looking at the ABCD. And this will be defined in great detail in the Peculiar Patterns module in the Harmonic Mastery course. We'll also talk about it in the Harmonic Trading versus Advanced Pattern Trading module in the Harmonic Mastery course. But I just want to give you guys some information up front so you're aware of what's still to come. The measurements we're looking at today in the bat pattern or the patterns in day 10 as well, they're not fully complete. We're still looking for another piece of the puzzle. So it's wise that you get to grips with all of the measurements we use and then progress to the Harmonic Mastery course. And then that's when you can really become a fully sustainable trader using the Harmonic Trading methodology. So just getting back to the basics, sometimes I I go off topic and I like to provide as much information as possible. But back to what we're really talking about, we're looking at extension measurements, not to confuse you, just keeping it simple here. We can see that price actually confirmed the extension measurement of 2. The 1.618, it confirmed that ratio, and it looks like it was in roughly the same area as that ratio of 2.24. This is the projection measurement. So we can see these two ratios could form within a close proximity. If I just remove the 2.24 and I look at the extension measurement and remove all of those, we're looking at a 2.0 ratio for the extension. This is really what I'm talking about when I'm speaking about the potential reversal zone. Ratios and different measurements forming within a close proximity. And you can see that the candlestick pushed below that 2.618, confirmed this 2.0 extension measurement, and then we got the reversal. And as I mentioned before, we're not going to be applying this extension-based measurement in our harmonic patterns today or in the 14-day course. This comes into play in the Harmonic Mastery course. We're just really looking at these basic formations. The only measurement you'll be using in day 9 and day 10 and in the 14-day course is retracements and projections. So we're just looking at the basic measurements of the patterns. And I feel that about covers it. Without dragging out too much, we want to head on to our last topic today and finish off the rest of day 9. Now moving on to our final topic for today, bullish and bearish bat. And this is where everything starts to piece together that we've learned in today's module. We learned about those M&W type structures and also the Fibonacci measurements, and we just combine those, and this is what gives us our harmonic patterns. We can see we've got an M-type structure here. We're looking at a bullish bat, X, A, B, C, D. These are the distinguished price points in a valid harmonic pattern. The B point in a bat pattern comes in at 0.382 to 0.5. So the minimum is 0.382. We really want price to test that level as a minimum measurement. That's the minimum retracement. And the maximum, we don't want price to far exceed 0.5. We really want price to complete within a close proximity. We want it to be less than the 0.618 measurement. But just for the purpose of the 14-day course and to reduce any room for error, I want you guys to look for very precise and accurate ratio measurements. So you want it to be exact 0.382 or exactly 0.5. You want it to be within a close proximity. You don't want it to far exceed that 0.5 measured level. And there is a degree of flexibility in these measurements, what we call a flexible framework. And this will be defined in the Harmonic Mastery course at a later date. The C point, we're looking at a minimum of 0.382 to 0.886. Like I said before, we're looking for a test of that minimum 0.382 to confirm the C point. And we really don't want price to far exceed the 0.886. Like I said with the B point, there is a degree of flexibility in these formations and these price points. The market is never perfect. We need to be open to adjustment. So price can slightly exceed that 886. It can slightly exceed that 0.5, but The extent in which it can exceed those measured levels will be defined in the Harmonic Mastery course. So you just for now, you really want to look for price to confirm these levels within a very close proximity. You want it to be within a close zone. The D leg, we measure that from B to C. That is our projection measurement. We're looking at a minimum of 1.618 and a maximum of 2.618. We really want price to confirm that 2.618 within a close area. And this is a defining element in the potential reversal zone. It's more of a complementary measure. The main measurement we're looking at is the X to D, and that is a 0.886 measurement of X to A. And don't worry if this is confusing you at all. I will give you a market example. We'll jump onto TradingView. We'll give you an example of a bullish and a bearish bat once we're finished with the slides. And like I said with the potential reversal zone, it's an area where all of these measurements converge. So in this potential reversal zone in particular, you're looking at the 0.886 and you're looking at potentially a 1.618 to 2.618 within that area. And you're also looking at an ABCD measurement, and this will be defined in the Harmonic Mastery course, as I mentioned in the previous topics. The alternate ABCD or the ABCD, this is something you may not be familiar with. And I don't want to confuse you guys too much. I really want you to get into the habit of spotting these M and W formations. I don't want to overwhelm you with too many measurements right off the bat. I feel that's where many people go wrong, and they go into a state of analysis paralysis, and they find it hard to move past that. They start procrastinating. So for now, I just want you to apply the basic measurements I'm showing you. And like I said before, what really makes a pattern harmonic is these Fibonacci or harmonic ratio alignments and sine wave structural assessments. And that's what we know as the ABCD. And like I said, we'll establish this in the Harmonic Mastery course. The next formation we're looking at is what's known as a bearish bat. We're looking at a W formation, the exact same as before, we're just flipping it. We're looking to sell in this situation, of course, once the pattern completes. When we're looking at a bullish pattern, we're looking to buy. A bearish pattern, we're looking to sell. And the B point, the exact same measurements. We're looking at a minimum of 0.382. We want price to test that level. We really want a minimum confirmation of that 382. And the maximum, we're looking at 0.5. We want price to be less than 0.618. Ideally, you want price to confirm an exact measurement at 382 or 0.5. It can be in between those measurements. I feel that's worth noting. It doesn't always need to be an exact 382 or an exact 0.5. Price can be inside those ratios. It can be within that range. But you don't want price to far exceed that 50% measured level. We really want it to be within a close proximity. The C point, we're looking at 0.382 to 0.886. Like I said with the B point, it can be in between that zone. So we can look for a 0.5 C point, a 0.618, a 707, a 786, all within that 1 C point measurement. And the D leg, we're looking at 1.618 to 2.618, and this will form in the potential reversal zone, as well as the 0.886 measurement of X to D. And like I said, the potential reversal zone, this is an area where all of these measurements converge. You're looking for the X to D or the X to A retracement to get our D leg or D point, our B to C measurement. These all form within a close proximity. And when these ratio measurements form within a very close range, that provides a really powerful harmonic trading setup. Before we head on to the charts, I'd just like to give you a short illustration on how to measure a bat pattern. Of course, I will show you how to do it when we're on the charts. To get our B point, we go from X to A. To get our C point, we go from A to B. And these are retracements. We use the Fib retracement tool. To get our D point, we go from B to C. And this is, of course, a projection using the Fib retracement tool again. To get our X to D of a 0.886, we go from X to A. And simply use your Fibonacci retracement tool to calculate the points shown above. So we don't use the extension tool to calculate any of those price points. The only time we use the extension tool is typically to calculate the alternate ABCD. And as mentioned multiple times, this will be defined once we reach the Harmonic Mastery course. So what I want to do now is go into TradingView. We'll take a look at the exact same formations as we did before. And the first pattern I want to look at is Great Britain Pound Japanese Yen, and it's a bullish bat. Welcome back to TradingView for the final time. Today we're now looking at Great Britain Pound Japanese Yen on the 4-hour chart with a valid bullish bat formation. And you can see here, I've already highlighted the M-type structure we're looking at in the market. This is the exact same one we looked at in the Finding M's and W's topic. I've highlighted each price point in the pattern. We've got X, A, B, C, and D. This highlights the completion of the pattern. This is where we look to execute the trade once price confirms the ratios within the potential reversal zone. And what I'm going to do is measure the move manually using the Fib retracement tool, and then I'll show you a far quicker way to do it using the XABCD tool that TradingView provides. The first measurement, we're going from X to A, and before we do that, I'm just going to add in the ratios of 0.382 and 0.5. As I mentioned before on the slides, we need price to test this minimum 0.382 measurement. It could even be the wick of the candlestick. You really want price to test this minimum measured level, and you don't want it to far exceed this 0.5. We want it to be within a close proximity. And as I've mentioned multiple times, you'll probably be sick of me saying it now, this will be covered at a later point. The threshold beyond the 50% that we're looking at. But to keep it simple, let's just look at exact ratio confirmations. This B point is considered a 0.382. And this is simply because price is closer to the 382 measurement than it is a 0.5. And this is what I was talking about when price can be in between this measured zone. It's still a valid pattern. It can be in between 0.382 and 0.5. It can be just beyond the 0.5, but you really want it to confirm this exact measured level. And when price goes beyond the 382, if it's closer to the 382 than it is the 50% or the 0.5, we then consider this a 0.382 measurement. If price is closer to the 50% of the 0.5 measurement, we then consider this, in this situation, this would be a 0.5 ratio. If I just adjust these levels again, our next measurement we're looking at is the C point. We're going from A to B. We can see price definitely confirmed that minimum 0.382. The maximum is 0.886. We don't want price to go far beyond that measured level. And to me, it looks like it formed a 707. You can see price confirmed a 0.707 retracement from A to B. That formed our C point. We had multiple tests of that area. We can see that price actually tests this level after the successful move. And this is what started our C to D leg, this impulsive move down to confirm the ratios in this zone. And this is the most important element of the pattern that we're looking at, the potential reversal zone. This is what defines the reversal for the pattern. We're looking at, of course, a D point or a D leg. We're looking at a minimum of 1.618. We're going from B to C with the Fib retracement tool, and the maximum of 2.618. And we can see price confirmed that ratio almost perfectly, and that is when we got the reversal. The last measurement we're looking for, or the last measurement we're going to explain today, is the X to A measurement of 0.886. This is really a defining element in the bat pattern, and this is what really sets up the potential reversal zone, as well as all of the other measured levels in the area. And if I just remove this trend line to clean up the charts a bit, and I'll take away this 1.618, we can see we've got the 886 of the X to A. This is a retracement. That gives us our D point. We also have the D leg measurement of the B to C projection. And we can see how these form within a very close proximity, a close area. That's really what we're looking for in the potential reversal zone. When we have these ratios forming within a close area, they typically have a greater potential for a reversal. And if we compare that to a move when ratios form like this, you typically will see that price will result in a loss. Not in all situations, but the they yield a greater potential when these ratios really form within a close area, like so. If they form within a close area and price test all of the measured numbers in the zone, as we can see here, this is exactly what it did. If I just zoom in on this D point, you can see price confirmed at 886. And the last number in that zone that was tested would have been around about this candlestick here, tested to 2.618, and this is what we would call the terminal price bar. The terminal price bar is the candlestick to test the last measurement in the potential reversal zone. And this may be the BC projection. For the D leg, it may be the X to D or the X to A measurement of 0.86, or it could even be the ABCD. And this won't be defined until the Harmonic Mastery course. I don't want to confuse you guys too much. I want to keep it as simple as possible, because harmonic trading really is an advanced methodology, and many traders fail to understand the true measurements that the patterns use. And once you get this confirmation in the zone, you really want to look for reversal candlestick formations once the pattern completes. We can see here we've got several doji formations, a hammer candle here as well. And then we had I would probably say this is a long day away from the reversal zone, and that's what started to move to the upside. So as we learned in day 5, Japanese candlesticks, we learned about aggressive candlestick formations, we learned about reversal candlestick formations such as shooting stars, hammer candles, hanging man. We learned about all of those types of candlestick formations and dojis as well, more neutral formations. You really want to look for these reversal or what I call stalling candlesticks in the potential reversal zone. Once price has tested these measured levels, you want price to form or provide information that a reversal is about to take place. And these reversal candlestick formations are what I call stalling candlesticks, such as dojis or maybe a hammer candle. They provide us with that information. Now there's good news. There is an easier way to draw in these patterns, a far easier way. And what you can do is go roughly about 5 down, 1, 2, 3, 4, 5, 6 down. We're looking at the XABCD pattern tool. It's about 5 or 6 down. And we're going from wick to wick. We're going from low to high, high to low. And we can see this already provides the measurements for us. We're looking at the D point completion. This defines the D point. We're looking at the 0.886, which completes here. And look how easy that is, how much chart time that would save. Rather than drawing in all of these measurements manually, we can automatically get the framework we need. It's far more clearer this way as well when we're looking at an M or W formation. Especially when you highlight it, you can obviously change the color. You can make it bolder. I prefer it to be more transparent. We can see the B point 0.4. This is closer to the 382 than the 50, or the 0.5. So this is considered a 0.382 measurement. The C point, it's closer to 0.707 than 0.786. We then consider this a 0.707 measurement. The D leg, we can see it's almost a 2.618. So it's worth noting that you really want to draw in these measurements in the potential reversal zone. Even if you're using the XABCD tool, you want to draw in these measurements as well and see where they complete. You could add in the 2.24. This can provide a zone where you look for a price to test these numbers. And of course the 2.618, because it is closest to the 886, that's really the measurement I would have went with in this trading situation. You can see price, of course, we got a test of this ratio. Didn't go too far beyond the 2.618. We like to see it within a close area. It can exceed this measured level, although it is the maximum. And then that's when we got the reversal. You can see literally turned on the pin, turned to the pit, straight to the upside. And as I highlighted before, we got the pullback. And then we got the full extent of the move, and that's extremely aggressive. And bear in mind, this is on the 4-hour chart, but this move would have completed around about this area here, and it was all done within less than 20 days, it probably would have been around about this area here, so about 19 or 20 days, 81 candlesticks, a really successful move, and I really do like this pattern. It's a really nice trading opportunity. And as mentioned before, the take profit levels, where you get out of the trade in profit, and the stop loss level, which defines the setup invalid, where you take the loss and you move on to the next trading opportunity. This will be defined in day 12 risk management. And you'll notice this with all of my education. When I'm teaching, every module pieces into the next. It's almost like a puzzle. And as I'm talking about the measurements, and some measurements are explained in the harmonic mastery, and this is for a very good reason. We want to keep it as simple as possible and just progress ever so slightly into the next stage of harmonic trading. We don't want to overwhelm you with too much information from day one. I want to ensure that you guys can correctly trade these patterns. You can correctly identify valid measured moves. And I put in the steps necessary to make that happen. I feel like that's us done with this formation. That is a bullish bat, and we can see it resulted in a successful move. And just one thing before we head on to the next topic. You really want to execute the trade once we confirm all of the ratios in the zone. What you don't want is price to, let's say, when price is testing the ratios, we want to wait in the candlestick close. Remember this terminal price bar that tests the last measurement in the zone. We want to wait in that candlestick closing, and then we look to enter the move. And that's extremely important, because what you don't want, and let's just assume this is where all our measurements converge. I'll just copy and paste this. I'm just trying to provide as much information as possible without confusing you guys. Let's say all the measurements complete here. What you don't want is this price level is tested, but you don't wait for the candlestick to close, and actually it far exceeds that level, and you've entered the move, and automatically you could have avoided that losing position. So you want to wait for the candlestick to close once the ratios have been tested, and then look to enter the move, and that's extremely important. And when you have a losing position, of course, very simple. You may have a slight period of consolidation in the potential reversal zone, and then price may continue downtrending from the CTD leg, and really that's where you're taking the loss. You're taking the loss around about this area here, beyond X. But as I mentioned, this will be defined in day 12. The next pattern we're looking at is a bearish bat formation. This is on Canadian dollar Swiss franc on the 1 hour chart. And we can see we've got this distinct W formation that we highlighted earlier in today's module. And we're just going to measure the move manually like we did with the bullish bat. First of all, we're going from X to A with this B point retracement. And the reason I selected this formation is because the B point slightly exceeds this 50% measured level, and I just want you guys to know it's still valid. We want it to be as close to this 50% as possible. There is a certain threshold in the B point in most formations. You want it to be within a close area. And for the purpose of the 14-day course, as I mentioned, we want price to be as close to these numbers as possible. In between is perfectly fine, and we want to have that minimum test of the 0.382. When we've got above this 50% level, we want to be within a very close area. We don't want price to far exceed this measured level. We're looking at the C point, which is an A to B retracement. And I can tell you guys this is looking like a 0.886, which is the maximum. And just like the B point, we don't want price to far exceed that measured level. We want to be as close to that as possible. And if we're going from the highs to lows, which is this area here, we're almost testing that 0.886. It's almost a test of that level. We would then consider that a 0.886 measurement. We're then going from B to C to get our D point projection, or D leg. This is a 1.618 to a 2.618. This is likely a maximum of 2. Just ensure these points match up. And in this situation, you're more than likely looking for that 1.618 measurement to complement the potential reversal zone. Could even be considered a ratio of 2, even though we didn't get an exact confirmation of the level. We're then going from X to A once again. We're looking at a 0.886, and that defines the completion of the pattern. This is an important number in the potential reversal zone. We need price to confirm this measurement before we're looking for an entry or looking to execute the position. I'll just remove this trend line, and I'll clean the charts up a bit. I'll remove that ratio of 2. We definitely confirmed that minimum 1.618. It could be considered as a ratio of 2, but we did get the confirmation here. You can see after price confirmed that 0.886, that's when we got the reversal. And as mentioned multiple times, there is only one other additional measurement we look for in these formations, and it's an ABCD. And I don't want to keep repeating myself, but will be defined at a later date. So there is only one other measurement we look for in this potential reversal zone. The key measurement that we're looking at today is this X to D, because that sets up the potential reversal zone, and this B to C projection for the D leg, it complements that area. So you just need to bear in mind that these are separate measurements. They're individual measurements. You want to be aware of where they complete individually, just so you can be more precise and more exact in your trading, in the identification process, and also in the execution as well, so you can get the best entry point possible. And just going off the ratios we have in this zone, the terminal price bar would have been this area here. This candlestick in this area, it confirmed the last ratio in the potential reversal zone. And ideally, we want price to close below this last measured level as well, which we did. It formed as a shooting star or possibly a doji candle, which is a good confirmation. And we got that nice reversal off of the X to D measurement, or the X to A measurement, sorry, the 886 level. We got a nice reversal off of that. It probably didn't complete the full extent of the move. Judging by where price reversed in this area here at the B point, it probably fell short of our final take profit level, which is yet to be defined in a later module. We then got a secondary test of the D point, or the potential reversal zone, which is common in harmonics. Don't be disheartened if you go into a nice profit and you hold on to the move and you don't reduce your position, and then price reverses and goes against you. It's quite common for price to test this level again, or this area, consolidate, and then it completes the full extent of the move. And that's exactly what happened in this situation. If I just flip this arrow around, it was only after this secondary retest, or this secondary test, it completed the full extent of the move. And we would have closed out this position roughly around about this area here. That would have been our final take profit level. So we can see the first move down, it didn't carry to our final take profit level. This is probably where we would have took profit and closed the trade entirely. It was only after we got this secondary test that price completed the full extent of the move, and that is when the larger downtrend started. And as mentioned with the previous setup, if price continued past D, for example, then this would of course result in a losing trade, and then it would be considered an invalid setup, and we'd be looking at the next trading opportunity. And this obviously will happen. It's to be expected in future trading opportunities. Not every single trading opportunity will result in a profit. You will have losing positions. It's natural. Everybody does. I would be lying to you if I told you I didn't. Everybody loses in trading. But of course, we want to ensure that we turn over a profit consistently long term. And we also want to have more profitable positions than losing positions, preferably even a 60% profitability rate where you're right 6 times out of 10 would be excellent. And we don't need to be right 9 times out of 10. And to be honest, many traders that tell you they're lying to you. I don't think I know many traders that are consistently profitable 9 times out of 10. I don't think anybody is, to be perfectly honest. You will have losing positions, and it's to be expected. So just be aware of that. When you're looking for this reversal, there will be times where you do everything textbook. you do everything by the rules, and you lose the trade. And that is just part and parcel of the trade. That's how trading goes. You will have losing positions. Just to finalize everything we've spoke about today, before we go over our rookie mistake number 9, we like to use the XABCD tool. We're always going from the highest and lowest points. We're looking for these ratio measurements to form within a close area, a close proximity, is what I like to say. Kind of treating it as a flexible framework, because as I mentioned before, the market is never perfect. At times you will get exact ratio confirmations, and that is really what you're looking for. We're just looking for price to test that measured level within a close area, to confirm that price level, and then we're looking for the next measurement in the move. And we can see we've got a 0.52. It's not far beyond that 0.5, that 50% measured level. As I mentioned before, you can display these ratios as percentages, just depending on what you feel comfortable with. I don't think you can do this with the XABCD tool, but you can do it with the Fib retracement tool, which is this tool here. And this would be a 50% retracement level. So it's roughly 2% above. That would be 52%. And that's that's very reasonable, if I'm being honest. That's within a very close area of the 50% maximum for the B point. We know this is a 0.886. Again, it's closer to the 886 than it is the 786. It almost confirms the exact ratio. I would definitely consider this an exact ratio alignment. We're always looking for the exact ratio for the X to A measurement, this retracement. We need price to test this XA retracement for 0.886, and this defines the potential reversal zone. It's a defining element in the back pattern. And in this BC measurement, to give you the D leg, we can see it's 1.8 roughly. We know that price confirmed 1.618 in this area here, and the 2.0 ratio was just above this secondary test. And we probably could have considered it a 2.0, but I'm really liking that minimum test of the 1.618 ratio. And that's what sets up this overall successful trading opportunity. You're looking for this area where all of these ratio measurements converge. And you really want them to form within a close area, a close proximity, as I keep mentioning. That is really what we're looking for. And that's what your potential reversal zone will really look like. So let's just head back to finish off the rest of today's module. We're heading on to our rookie mistake, and this is rookie mistake number 9. So to finish off today's module, we're going on to rookie mistake number 9. These are real trading mistakes that cost me a considerable amount of time and money. And today's rookie mistake is technical overload. And this is definitely something that affected me during the early stages of trading, and many people watching this can probably relate to this. If you're reading books, ebooks, watching YouTube videos, listening to a podcast, or whatever it may be, and you go out and you try to apply what is learned, you've learned tons of different chart patterns, and they show you how they appear in the books. They look perfect. And you go out and try and find one, and it just doesn't happen. And you're overloading yourself with all of this technical information, and what happens is it puts you into a state of paralysis, and you don't actually do anything at all. You try and find all of these chart patterns, and most of the time they end up being wrong, or you're losing a lot of positions and you don't quite understand why that's happening. And really, when it comes down to it, it's just because you really don't understand it. You're overcomplicating it too much, and that happens a lot with harmonic trading. So you have now learned the core principles of an advanced technical strategy. As you've learned today, harmonic trading is an advanced technical approach to the market. Many people fail to understand it completely, and that's of course why you're now doing the 14-day course and the Harmonic Mastery course. What I want you to do is just think about harmonic patterns in their most simple form. I don't want you to overcomplicate it. I want you to strip it down to its most simple form. What did you learn today? You learned that harmonic patterns combine two schools of technical thought. Harmonic patterns are simply M's or W's, with some added maths. They're measured moves. They're measured through something called Fibonacci, retracements, and projections. Okay, that's simply it. And to make it even more simple, I've gave you the ratios for a valid bullish and bearish back, which is one type of harmonic pattern, and you've got a tool on TradingView to draw them in manually. So what do you need to do? All you need to do is start identifying M and W type structures on the charts. So we are not mad scientists. Again, Fibonacci, it is a very in-depth concept, but you don't need to have higher mathematics. You don't need to be, you don't need to have a degree to understand how to use it or understand its application. You don't need to understand it on a deeper level. You just need to understand how it works when applying it to the charts. You just need to understand when you apply it to harmonics, are we looking for a retracement level? What are the ratios or percentages I'm looking for a B point? What are the percentages or ratios I'm looking for a C point? And that is all you really need to know. Harmonics are simply M's and W's with some added mathematics. That is it. So let's just wrap it up for today. It's been a long module again. I love to give you guys as much content as possible. Everything that is going around in my head it's been put out here for you guys to learn from. So start with recognizing structure, add the ratios later. So what I want you to do is go off today, if you've got time today, if not, tomorrow, and start spotting M's and W's in the market. It's all about training the eye through repetition. And I told you about this in day one. It's all about repetition, repetition, repetition. I can't make you find harmonics. You need to want to go out and do it yourself. So again, all of the knowledge you gain from this course, you need to apply it in the markets. So again, go off today, start spotting the M and W structures, and then add the ratios after. So again, when you're looking for these formations in the market, that's exactly what we do. We look for M and W type formations, and then we measure the move. So the more patterns you correctly analyze, the easier it will become. And trust me, you'll get to a point where you can open a chart and you can just say, that is a bat pattern. You don't even need to measure it. You could just tell me, Lewis, that's a bat pattern. And that's exactly the kind of stage I want you guys to get to in your trading. Now, once you become comfortable with spotting M and W style formations, as mentioned, you can then apply the measurements. So again, the more technical side, you can then measure the move. So start to familiarize yourself with the ratios. Again, going from 0.236 all the way down to 3.618. Again, start to familiarize yourself with them. Use them whilst you're trading. You can, again, you've got a screenshot, you've got them in your notebook. Use them whilst you're looking through the charts. And just remember, again, I'm keeping it simple here. There's only two trading opportunities when you're trading harmonics. And again, when you're trading any chart, any strategy, bullish or bearish. You're looking to buy or you're looking to sell. Now in our next module, which is day 10, advanced harmonic patterns. So again, we're just leading on from day 9. We will go over bullish and bearish Gartley, bullish and bearish butterfly, and bullish and bearish crab. So we've got 3 more types of harmonic patterns coming tomorrow. Today you learned the bullish and bearish bat. So after tomorrow, you'll have 4 harmonic patterns you can use to trade the Forex market or cryptocurrency market, whatever market you will be trading after the course. I'd like to thank you guys for joining me on today's module, and I'll see you on the next video.